Before we get into what a stock is, let's start with 3 reasons why you should consider owning stocks in the first place. The first reason is that stocks have demonstrated proven results over 10 or more year time horizons. And when I say 10 or more years, I'm meaning that basically if you're looking to take money out of your portfolio, say in a year, maybe you're saving up for a house or, college expenses for your kids, something that you need money for within the next, say, 10 years, you should not invest that in stocks. And the reason is that over a 1-year period, stocks can lose a lot of money pretty rapidly, and it happens a pretty decent amount of time. Maybe 25-30% of years, stocks will experience losses, and those can sometimes be pretty severe. So this chart is from JP Morgan Asset Management. Basically shows the returns of stocks over different time periods going back to 1950. So on the left, we see the rolling 1-year returns. The worst for stocks was negative 39%. The best was positive 47%. You compare that to bonds, on the other hand. The worst 1-year return for bonds was only minus 8%, and the best was plus 43%. So, as you can see, huge potential for loss and huge potential for gain in stocks, and anything in between could also happen. So 1-year time horizon, you should not own stocks. You really probably shouldn't even own bonds. This money is probably best in cash or something that's going to just preserve what you've got. If your time horizon is at least 5 years, now our potential for loss in the stock market is quite a bit lower. These are annualized numbers, so keep that in mind, that the worst 5-year rolling return for stocks over this period was negative 3% per year, or roughly negative 15% in total. If you go out even further, out to 10 years, the worst return for stocks is now only minus 1% per year, or about 10% overall. And then out 20 years, there was never a rolling period where stocks lost money. In fact, the worst 20-year rolling return was 7% per year, which would double your money about 4 times from where you started. So you can also see they've shown the growth of 100,000 over 20 years on average. And for stocks, this is $823,000 if you invested $100,000 at the beginning of that 20-year period, and the average was 11.1. So if your time horizon is at least 5, 10, ideally 20 or more years, stocks have proven themselves to be tremendous wealth building assets, particularly compared to bonds, cash, gold, or really any asset you compare it to. Stocks are often at the top or near the top in wealth building potential. The second reason to consider stocks is that they are accessible to all people. Back a couple decades ago, only wealthy people could invest in stocks. It really was not available to everyone. That is not the case anymore. You can have as little as $5 and start investing. The final reason to consider investing in stocks is that investing in the market is a passive exercise, or it can be at least. That just simply means that once you put in the money, so you have to work to get the money to begin with, but once you have that and invest it, the companies that you're investing in are doing the work for you. So when you own a stock, you own a company, and the owner of the company does not actually have to go to work, right? The employees are going to work for you. They're waking up at 6 a.m., going in, selling to customers, manufacturing products, coming up with new ideas, designing new things. All of that is for you. You're the owner. You don't work, they work, and you are the beneficiary of their labors. Obviously, you pay them for their work, but you are the ultimate beneficiary of the profits and losses of that particular company. There's also no active management required. You could buy and sell stocks, doing research, deciding when to buy, what to buy, that sort of thing. Or you can invest in index funds, which is basically, we'll talk more about that in a minute. It's basically just a way to passively participate in the fortunes of a bunch of different companies all at once. So the S&P 500, for example. It's just a basket of 500 large companies traded in the United States. You don't have to do anything to buy that. You just buy it. You don't have to pick stocks. You just buy into that and forget it. It's also extremely easy to buy and sell. This is referred to as liquidity. So if you, say, own a house, it can be very difficult to both buy a house and sell it. You've got to look around, find the right buyer. They've got to go through credit checks. You've got some things to do with the house. They got to do a survey, and they have to do an inspection. They do all these things, and sometimes it doesn't work out. It's not a liquid exercise. It takes time. There's costs involved. When you buy stocks, sell stocks, it happens really in the blink of an eye. I mean, you can sell hundreds of thousands of dollars in stocks within a couple minutes, and the cost of doing so might be a penny a share or something like that. So it's very liquid, very easy to make transactions.